Money is one of the most powerful forces in human life. It shapes our choices, our freedom, and often our future. Yet most people spend years working for money without ever learning how money truly works. Many believe investing is complicated. They imagine complex formulas, endless charts, and constant trading. But history quietly shows a different truth. The greatest investors did not succeed because they were the smartest in the room. They succeeded because they followed simple principles with patience and discipline. Warren Buffett once said that investing is simple but not easy. Simple because the rules are clear. Not easy because following those rules requires emotional control and long-term thinking. In a world filled with noise, predictions, and endless opinions, it becomes easy to forget the basics. People chase quick profits, follow the crowd, and react to every headline. But true investing is not about speed. It is about clarity, patience, and quiet confidence. This audiobook presents a simple code, a set of timeless rules that guide smart investors through uncertainty, opportunity, fear, and excitement. These rules are inspired by the wisdom of great thinkers, legendary investors, and lessons learned from decades of market history. You do not need to be a financial genius to follow this code. You only need curiosity, discipline, and the willingness to think long-term. Because every successful investing journey begins with understanding one simple truth. Wealth is not built by chance. It is built by following the right principles again and again over time. And the first principle begins with a habit so simple that many people overlook it. Rule 1. Respect money and understand its value. Every journey toward wealth begins with a simple realization. Money is not just paper, coins, or digital numbers on a screen. Money represents time, effort, skill, and life energy. When a person earns money, they are exchanging hours of their life for value. That is why respecting money is actually respecting your own time and effort. Many people dream about becoming wealthy, yet they treat money carelessly. Small expenses are ignored, savings are postponed, and investment decisions are made without thought. Over time, this lack of respect quietly destroys financial progress. Benjamin Franklin once said, "Beware of little expenses, a small leak will sink a great ship." This wisdom has remained true for centuries. Wealth rarely disappears through one big mistake. It often disappears through many small, careless habits. Respecting money begins with awareness. You must know where your money comes from and where it goes. Every dollar should have a purpose. This does not mean living in fear of spending. Money exists to improve life, create comfort, and provide security. But spending without thought creates dependence instead of freedom. Warren Buffett once shared a simple truth. Do not save what is left after spending, spend what is left after saving. This small shift in thinking can change an entire financial future. When you respect money, saving becomes natural. Saving is not about deprivation. It is about preparation. A farmer plants seeds today so that crops can grow tomorrow. In the same way, savings become the seeds of future wealth. Every successful investor began with the same habit. They valued every unit of money and treated it as a resource that could grow. Charlie Munger, the longtime partner of Warren Buffett, once explained that the first $100,000 is the hardest to earn. Not because of intelligence, but because it requires discipline. Discipline to save, discipline to wait, discipline to resist unnecessary spending. But once that foundation is built, something remarkable begins to happen. Money starts working for you instead of you constantly working for money. This is the turning point in the life of an investor. Respecting money also means protecting it from foolish decisions. Exciting opportunities often appear promising, but many of them are traps driven by hype and emotion. Smart investors understand that every dollar is a worker. When invested wisely, that worker produces more workers, and over time, the small army of money begins to grow. However, none of this growth can happen if money is wasted before it ever reaches investment. Think of money as the fuel of your financial engine. Without fuel, the engine cannot move forward. Without savings, investing cannot begin. This is why the first rule of investing does not start with markets, companies, or strategies. It starts with respect. respect for the value of money, respect for the effort required to earn it, and respect for the discipline required to grow it. Once this mindset becomes part of your daily life, the path toward investing becomes much clearer. Because after learning to respect money, the next step becomes obvious. You must give your money time to grow. Rule 2. Think long-term, not short-term. Once you learn to respect money, the next step in the investor's code becomes clear. You must give money time to grow. Many people enter the world of investing with excitement and urgency. They want quick results, they want fast profits, and they want wealth to appear almost immediately. But the financial markets rarely reward impatience. In fact, impatience is one of the main reasons why many investors fail. Warren Buffett once explained this truth in a very simple way. The stock market is a device for transferring money from the impatient to the patient. These words reveal one of the most powerful ideas in investing. Time is the greatest partner of a disciplined investor. Think about how nature works. A tree does not grow overnight. A farmer cannot plant a seed today and expect a harvest tomorrow. Growth requires time, patience, and consistency. Investing follows the same natural law. When people think only about the short term, they become trapped by daily market movements. Prices rise and fall, news headlines appear every hour. Predictions fill the air with excitement and fear. Short-term thinking turns investing into a stressful game of constant reaction. Every small movement feels important. Every rumor feels urgent. But experienced investors learn to step back from this noise. They understand that great companies grow slowly over many years. Strong businesses expand their products, improve their services, and reach more customers over time. Those who stay invested long enough allow this growth to work in their favor. John Bogle, the founder of Vanguard and a pioneer of long-term investing, once said something very powerful. Time is your friend. Impulse is your enemy. This idea captures the essence of long-term thinking. When investors act on impulse, they buy when excitement is high and sell when fear appears. This pattern leads to poor results again and again, but patient investors follow a different path. They focus on the strength of the business rather than the daily price. They invest with the expectation that growth will happen gradually, and they allow the power of compounding to work quietly in the background. Compounding is one of the most extraordinary forces in finance. Small returns earned consistently over many years can transform modest savings into significant wealth. Albert Einstein once described compound growth as the most powerful force in the universe. Whether this quote is perfectly accurate or not, the idea behind it remains deeply true. Time multiplies effort. A small investment growing steadily over decades can achieve results that seem almost unbelievable. But this miracle happens only for those who stay patient. Short-term investors are often distracted by temporary losses or temporary gains. They jump from one opportunity to another, searching for the next quick success. Long-term investors understand that wealth is built slowly. They accept that markets will rise and fall. They know that uncertainty will always exist. But they also trust that strong investments grow stronger with time. This mindset creates calm and confidence. Instead of reacting to every market movement, long-term investors stay focused on the bigger picture. They allow businesses to grow, they allow investments to mature, and they allow time to perform its quiet magic. But long-term patience alone is not enough. An investor must also know where to place their trust. Because the next rule of the investor's code reminds us of something essential. Before investing in anything, you must truly understand it. Rule 3. Invest only in what you understand. After learning to respect money and think long-term, the next principle becomes essential. You must clearly understand what you are investing in. Many people lose money not because markets are dangerous, but because they invest in things they do not truly understand. They hear about a new opportunity, they see others making money, and they rush to participate without asking deeper questions. This behavior turns investing into speculation. Warren Buffett has repeated a simple rule throughout his career. Never invest in a business you cannot understand. At first, this idea may sound limiting, but in reality, it protects investors from many unnecessary mistakes. Every business has its own story. A company produces products, provides services, competes with rivals, and earns profits in different ways. If you cannot explain how a company makes money, then you do not truly understand the investment. Understanding creates confidence. When markets fall, confused investors panic. They sell quickly because they do not know what they actually own. But informed investors behave differently. They remain calm because they understand the strength of the business behind their investment. Peter Lynch, the legendary investor who managed the Fidelity Magellan Fund, often said something very insightful. Know what you own and know why you own it. This simple sentence captures the heart of intelligent investing. Imagine investing in a company that sells products people use every day. You understand its services. You see customers buying from it regularly. You observe how the business grows over time. In such a situation, your investment decision is based on understanding, not hope. But when people invest in complicated ideas that they barely understand, fear grows quickly during uncertainty. And fear often leads to poor decisions. This is why great investors often stay within what Warren Buffett calls the circle of competence. Your circle of competence includes the industries, products, and businesses you can understand clearly. Inside that circle, you can analyze opportunities wisely. Outside that circle, confusion and risk increase. Interestingly, successful investors do not try to understand everything. Instead, they focus on understanding a few things deeply. Charlie Munger once explained that it is better to be consistently not stupid than occasionally brilliant. In other words, avoiding obvious mistakes can be more powerful than chasing complicated strategies. Understanding a business does not require advanced mathematics. It requires curiosity and observation. Ask simple questions. What does the company sell? Who buys its products? Why do customers choose it instead of competitors? Does the business have a strong reputation? Can it grow in the future? These questions bring clarity. Investing should never feel like gambling. If you cannot explain your investment in clear and simple language, then more learning is needed before committing money. Great investors remain lifelong students. They read, observe, and think carefully before making decisions. This habit builds confidence and reduces unnecessary risk. Because when you truly understand a business, patience becomes easier. Volatility becomes less frightening. And investing becomes a thoughtful process instead of an emotional reaction. But understanding alone is not enough. Even intelligent investors must learn another important lesson. Sometimes the crowd becomes excited about opportunities that are not truly valuable. And that leads to the next rule of the investor's code. Rule 4. Do not follow the crowd blindly. Human beings naturally feel comfortable moving with the crowd. When many people believe something is right, it feels safe to agree with them. This instinct has helped humans survive throughout history. But in the world of investing, following the crowd often leads to trouble. Financial markets are deeply influenced by emotion. Excitement spreads quickly. Fear spreads even faster. When prices rise rapidly, people begin to believe that the trend will continue forever. Friends talk about profits. News channels celebrate the rising market. Social media fills with stories of quick wealth. In such moments, the crowd becomes confident and enthusiastic. Many investors rush in, hoping they will not miss the opportunity. Yet history has shown that extreme optimism often appears near the top of a market. Sir John Templeton, one of the greatest investors of the 20th century, explained this pattern clearly. He said that bull markets are born in pessimism, grow in skepticism, mature in optimism, and die in euphoria. Euphoria is the moment when almost everyone believes that prices will keep rising forever. At that stage, caution disappears. Reason becomes weaker than excitement. Investors who blindly follow the crowd during these moments often pay the highest prices. Soon after, reality returns. Prices fall. Fear replaces excitement, and the same crowd that once rushed to buy begins rushing to sell. This cycle has repeated itself many times throughout financial history. The dot-com bubble at the beginning of the new millennium. The housing crisis that shook the global economy. Many other smaller bubbles in different industries. Each time, the pattern was similar. A powerful story captured public imagination. The crowd believed extraordinary profits were guaranteed, and investors who questioned the excitement were ignored. But wise investors think differently. They understand that popularity does not equal value. Warren Buffett once said something that perfectly reflects this mindset. Be fearful when others are greedy, and be greedy when others are fearful. This idea does not mean always doing the opposite of the crowd. Sometimes the crowd can be right. The real lesson is to think independently. Independent thinking requires calm analysis. Instead of asking what everyone else is doing, ask what makes sense. Is the business truly valuable? Are the expectations realistic? Is the price justified by the company's long-term potential? These questions protect investors from emotional decisions. Great investors develop the courage to stand apart from the crowd when necessary. They remain patient when others rush. They remain calm when others panic. This independence does not come from arrogance. It comes from discipline and thoughtful reasoning. Benjamin Graham, often called the father of value investing, once described the market as a voting machine in the short run and a weighing machine in the long run. In the short run, popularity determines prices. In the long run, true value determines outcomes. Those who follow the crowd blindly focus only on the voting. Wise investors focus on the weighing. They know that temporary excitement will fade, but real value will eventually reveal itself. Learning to think independently is a powerful skill in investing. Yet even independent investors face another challenge that can quietly damage their decisions. Because the greatest battles in investing do not happen in the market, they happen inside the human mind. And that brings us to the next rule of the investor's code. Rule 5. Control your emotions. In the world of investing, knowledge is important, experience is valuable, but emotional control may be the most powerful advantage of all. Financial markets move every day. Prices rise. Prices fall. News spreads quickly. Opinions appear everywhere. All of this activity creates strong emotions in investors. When prices rise rapidly, excitement grows. People feel confident and optimistic. They begin to believe that success will continue without interruption. When prices fall suddenly, fear takes control. Investors become anxious. They worry about losing money and making mistakes. These emotional swings are natural. Every human being experiences them. However, successful investors learn how to manage these emotions instead of being controlled by them. Warren Buffett once explained a powerful truth about investing. He said that success in investing does not depend on intelligence alone. What matters most is temperament. Temperament means the ability to remain calm and rational when others are overwhelmed by emotion. Many investors buy assets when excitement is high. They see others making profits and feel pressure to join the trend. This behavior is driven by greed. Later, when markets decline, fear appears. Those same investors begin to worry that losses will continue. In panic, they sell their investments at exactly the wrong time. This cycle of emotional decisions repeats again and again. People buy when prices are high because they feel optimistic. They sell when prices are low because they feel afraid. Over time, this pattern quietly destroys wealth. Benjamin Graham described this problem with a famous metaphor. He imagined the market as a partner named Mr. Market. Every day, Mr. Market offers to buy your shares or sell you his shares at different prices. Some days, he feels very optimistic and offers high prices. Other days, he feels depressed and offers very low prices. But Graham explained that the investor does not need to react to every offer. The investor can simply ignore Mr. Market when his emotions become extreme. This lesson is powerful. The market will always produce emotional swings, but investors do not need to follow them. Instead of reacting to fear or excitement, disciplined investors follow a clear process. They study businesses carefully. They invest with long-term expectations, and they remain calm when markets move unpredictably. Charlie Munger once said that the big money is not in the buying or selling. The big money is in the waiting. Waiting requires emotional strength. It means resisting the urge to constantly act. It means staying patient during uncertainty. And it means trusting your long-term reasoning instead of short-term feelings. Emotional control also protects investors from overconfidence. After a few successful investments, some people begin to believe they cannot make mistakes. This false confidence often leads to careless decisions. Wise investors remain humble. They understand that markets are complex and unpredictable. They stay disciplined even during success. In the end, investing is not only a financial activity, it is also a psychological challenge. The market constantly tests patience, confidence, and discipline. Those who master their emotions gain a powerful advantage. They avoid panic during difficult times. They avoid reckless excitement during prosperous times. This emotional balance allows investors to make decisions based on logic rather than impulse. But emotional control alone cannot eliminate every risk. A wise investor must also protect their capital by spreading risk carefully. And that leads to the next rule of the investor's code. Rule 6. Diversify your investments wisely. Even the most careful investor cannot predict the future with perfect certainty. Markets change, industries rise and fall, new technologies appear, unexpected events reshape the global economy. Because of this uncertainty, wise investors follow an important principle. They do not place all their resources in a single investment. This idea is known as diversification. Diversification simply means spreading investments across different businesses, industries, and assets. Instead of depending on one opportunity, an investor builds a collection of investments that support each other. The purpose of diversification is protection. If one investment performs poorly, others may perform well. This balance reduces the overall risk to your portfolio. An old proverb expresses this idea very clearly. Do not put all your eggs in one basket. If the basket falls, every egg breaks. But when eggs are placed in many baskets, the risk of total loss becomes much smaller. In investing, this wisdom has proven valuable again and again. Great investors understand that mistakes are inevitable. Even the most experienced professionals sometimes misjudge a company or an industry. Diversification accepts this reality and prepares for it. Harry Markowitz, the economist who developed modern portfolio theory, once described diversification as the only free lunch in investing. His research showed that combining different types of investments can reduce risk without necessarily reducing long-term returns. This insight changed how many professional investors build portfolios. However, diversification should be thoughtful rather than careless. Owning too many investments without understanding them can create confusion instead of safety. Wise diversification focuses on balance, not excess. For example, an investor might hold companies from different sectors of the economy. Some businesses may operate in technology, others may provide healthcare services. Some may produce consumer goods that people use every day. Because these industries respond differently to economic changes, diversification helps create stability. Ray Dalio, the founder of Bridgewater Associates, often emphasizes the importance of balanced portfolios. He explains that diversification allows investors to survive uncertain environments. When one part of the economy struggles, another part may grow. This balance helps investors remain calm during market turbulence. Diversification also protects investors from emotional mistakes. If someone invests all their money in a single company, every price movement becomes stressful. Fear and anxiety increase quickly when too much depends on one outcome. But when investments are spread across different opportunities, no single decision controls the entire financial future. This creates psychological stability as well as financial protection. Yet diversification does not mean avoiding research. Every investment should still be chosen carefully. Quality matters more than quantity. A well-diversified portfolio is built slowly with thoughtful decisions. Each investment serves a purpose within the overall strategy. In the end, diversification reflects humility. It acknowledges that the future is uncertain and that no investor can predict every outcome. By spreading risk wisely, investors protect themselves from unexpected surprises. But even with diversification, another principle remains essential. Before seeking profit, a wise investor always considers potential loss. And that brings us to the next rule of the investor's code. Rule 7. Respect risk before chasing reward. Many people enter the world of investing with one main goal. They want to make money quickly. They search for opportunities that promise large returns and exciting growth. But wise investors approach the market from a different direction. Before thinking about profit, they first think about risk. Risk is the possibility of losing money. It is the uncertainty that comes with every investment decision. Ignoring risk can lead to painful consequences. Understanding risk creates protection and discipline. Benjamin Graham, the mentor of Warren Buffett and one of the founders of modern value investing, often emphasized this principle. He believed that the first duty of an investor is not to lose money unnecessarily. Warren Buffett later repeated a similar idea in his own famous words. Rule 1, never lose money. Rule 2, never forget Rule 1. Of course, losses sometimes happen in investing. Markets are unpredictable and no strategy is perfect. But Buffett's message highlights an important mindset. Protecting capital should always come before chasing profit. Many investors forget this lesson when they see exciting opportunities. They focus only on the possible reward. They imagine how much money they might gain. But they fail to ask an equally important question. What could go wrong? Wise investors carefully examine both sides of every opportunity. They consider the potential reward, but they also analyze the potential risk. This balanced thinking leads to more thoughtful decisions. For example, imagine two different investments. One promises very high returns but also carries a high chance of failure. The other offers moderate returns with much lower risk. An inexperienced investor may chase the exciting opportunity, but a disciplined investor studies the risks carefully before deciding. Howard Marks, a respected investor and author, once explained that risk is not always visible. During good times, risky investments often appear safe because prices are rising. But when conditions change, hidden risks suddenly become clear. This is why careful analysis is essential. Risk can appear in many forms. A company may have too much debt. An industry may face strong competition. A business model may depend on uncertain trends. Each of these factors increases uncertainty. Understanding these risks does not mean avoiding investing altogether. Instead, it allows investors to prepare and make wiser choices. One powerful concept in risk management is known as the margin of safety. Benjamin Graham introduced this idea to protect investors from unexpected errors. The margin of safety means buying investments at prices that provide a cushion against mistakes or bad outcomes. If the price paid is significantly lower than the true value of the business, the investor has a buffer against uncertainty. This principle turns investing into a more defensive activity. Instead of hoping everything will go perfectly, wise investors prepare for the possibility that things may go wrong. This mindset reduces the chance of permanent financial damage. Another important aspect of respecting risk is avoiding excessive confidence. After a few successful investments, some people begin to believe they can predict the market. This confidence can lead to reckless decisions. Disciplined investors remain cautious even when they succeed. They continue to analyze risks carefully before making new commitments. In the long journey of investing, survival is more important than speed. An investor who protects capital during difficult times gains the opportunity to benefit from future opportunities. But an investor who takes reckless risks may lose the ability to continue the journey. This is why risk awareness stands at the center of intelligent investing. By respecting risk first, investors build a foundation of safety. And from that foundation, sustainable growth becomes possible. However, understanding risk leads naturally to another important insight. To evaluate risk properly, an investor must study something deeper than price movements. Because real investing is not about numbers on a screen, it is about the strength of real businesses, and that leads to the next rule of the investor's code. Rule 8. Study businesses, not just prices. Many new investors begin their journey by watching prices. They open market charts, observe numbers moving up and down, and try to guess where prices will go next. This approach turns investing into a game of prediction. But experienced investors understand a deeper truth. Behind every stock price is a real business. A company produces products, serves customers, hires employees, and earns profits through its operations. The stock market simply reflects the value of that business over time. When investors focus only on prices, they see only the surface. When they study the business itself, they begin to understand the true foundation of the investment. Warren Buffett has always emphasized this principle. He once explained that when he buys shares of a company, he thinks of himself as buying part of the entire business. This perspective changes everything. Instead of asking whether the price will rise tomorrow, the investor asks more meaningful questions. What does this company do? Why do customers choose its products? Does it have a strong reputation? Is its leadership trustworthy and capable? Can the business continue growing in the future? These questions help reveal the true strength of a company. A business with loyal customers, strong management, and sustainable advantages often grows steadily over time. As the business grows, its value usually grows as well. But when investors ignore the business and focus only on the price, they become vulnerable to speculation. Prices can move quickly due to rumors, excitement, or fear. These short-term movements may have little connection to the actual quality of the company. Benjamin Graham described this difference with great clarity. He said that in the short run the market behaves like a voting machine, but in the long run it behaves like a weighing machine. In the short run, popularity and emotion influence prices. In the long run, the true value of the business determines the outcome. Wise investors therefore focus on the weighing, not the voting. They analyze how a company earns money. They study its financial strength. They observe how it competes in its industry. Over time, this deeper understanding creates confidence. When market prices fall temporarily, investors who understand the business do not panic easily. They know that short-term volatility does not always reflect long-term value. Peter Lynch often encouraged investors to observe the businesses around them in everyday life. He believed that ordinary people can discover strong companies simply by paying attention to the products and services they use regularly. If customers love a product and continue buying it year after year, that company may have a strong foundation for growth. Studying businesses also helps investors avoid weak companies. Some businesses appear exciting at first, but lack sustainable advantages. They may depend on temporary trends or fragile strategies. Without careful analysis, investors might mistake excitement for strength. But when you study the business carefully, weaknesses become easier to recognize. This habit transforms investing from guessing into thoughtful decision-making. Instead of chasing market movements, investors evaluate real economic value. Over time, this disciplined approach leads to better choices and greater confidence. Because when you understand the business behind the investment, you begin to see beyond short-term price changes. And this deeper perspective leads naturally to another important principle. A good business is not always a good investment if the price is too high. That is why the next rule of the Investor's Code focuses on one of the most important ideas in investing. Rule 9. Value matters more than popularity. In financial markets, popularity can be very powerful. When many investors become excited about a company, its price often rises quickly. News headlines celebrate its success. Analysts praise its future, and investors rush to buy shares before the price climbs even higher. At first glance, this enthusiasm may seem like a sign of strength. If everyone wants to own a company, it must be a great investment. But wise investors know that popularity does not always equal value. A company may be excellent, yet its stock can still be a poor investment if the price becomes too high. This distinction between price and value lies at the heart of intelligent investing. Warren Buffett explained this idea in a simple and memorable way. Price is what you pay. Value is what you get. Price is the amount of money required to buy an investment. Value represents the real worth of the business behind that investment. Sometimes the market price of a company rises far above its true value because investors become overly optimistic. Excitement spreads. Expectations grow larger and larger. But eventually reality returns. When expectations become unrealistic, even a good company can disappoint investors. The price may fall sharply, not because the business failed, but because it was priced too high in the first place. This pattern has repeated many times throughout financial history. During periods of intense enthusiasm, investors often focus on stories rather than fundamentals. They imagine unlimited growth and extraordinary profits. But wise investors remain grounded in careful analysis. They examine the company's earnings. They study its competitive advantages. They evaluate whether the price reflects reasonable expectations for future growth. Benjamin Graham emphasized the importance of buying investments with a margin of safety. This means purchasing a business at a price that is lower than its estimated value. This difference between value and price creates a protective cushion. If unexpected problems appear, the investor is less likely to suffer a severe loss. In contrast, investors who buy popular companies at extremely high prices often have little protection. Even small disappointments can lead to large losses. Howard Marks once explained that successful investing is not about buying good things. It is about buying things well. A great business purchased at an unreasonable price can become a poor investment. But a solid business purchased at a sensible price can produce strong long-term results. This idea requires patience and discipline. When a company becomes extremely popular, its price may rise beyond reasonable levels. At that moment, the wise investor is willing to wait. Patience protects investors from the pressure of excitement. Markets constantly create opportunities for those who remain calm and selective. Instead of chasing the most popular stocks, disciplined investors search for businesses whose true value is not yet fully recognized. This approach may feel slower and less exciting, but over long periods of time, it often produces far better results. True investing is not about following trends. It is about recognizing value where others may not be looking. When investors understand this principle, they begin to see the market with greater clarity. They learn to separate excitement from reality. They focus on long-term value rather than temporary popularity. And once this mindset develops, another powerful force begins to work in their favor. A force that rewards patience more than brilliance. The quiet and extraordinary force of compounding. Rule 10. Let compounding work quietly. After understanding value and learning to avoid the traps of popularity, an investor discovers one of the most powerful forces in finance. This force works slowly, quietly, and patiently. Yet over time, it can transform small beginnings into remarkable wealth. This force is compounding. Compounding happens when the returns from an investment begin to generate their own returns. Money starts producing more money, and those gains continue growing year after year. At first, the progress seems small. The growth appears slow and almost unnoticeable. Many people become impatient during this early stage because the results do not seem dramatic. But compounding rewards patience more than speed. Albert Einstein is often credited with calling compound growth one of the most powerful forces in the universe. Whether the exact wording is perfectly accurate or not, the idea captures an important truth. Time magnifies consistent progress. Imagine a small seed planted in fertile soil. In the beginning, it looks insignificant. But with time, sunlight, and patience, the seed grows into a tree that produces countless more seeds. Investing follows a similar pattern. Small amounts of money invested wisely can grow steadily when returns are reinvested. Those returns then begin generating additional returns, creating a chain of growth that strengthens with time. The earlier this process begins, the more powerful it becomes. Warren Buffett is a famous example of the power of compounding. Although he is widely known as one of the wealthiest investors in history, much of his wealth was built gradually over many decades. His success did not come from a single dramatic investment. It came from consistent decisions and the patient reinvestment of profits year after year. This lesson reveals something very important. Wealth through investing is rarely created through sudden breakthroughs. It is created through steady progress. Compounding rewards those who remain disciplined and patient. However, the power of compounding depends on two essential conditions. The first condition is time. The longer an investment continues growing, the greater the effect of compounding. The second condition is consistency. Regular investing and reinvesting returns allow the compounding process to continue without interruption. Many investors weaken this process by constantly interrupting it. They sell investments too early. They chase short-term opportunities. They withdraw profits instead of allowing them to grow further. Each interruption slows the compounding effect. Charlie Munger once explained that the first rule of compounding is never interrupt it unnecessarily. This wisdom highlights the importance of patience. When investors allow their investments to grow steadily over many years, the results can become extraordinary. The early years may look modest, but as time passes, growth accelerates because each gain builds upon the previous gains. This is why long-term investors often appear quiet and patient. They understand that time is working silently on their behalf. Instead of searching for constant excitement, they allow the compounding process to unfold naturally. In a world that celebrates speed and instant results, compounding teaches a different lesson. Great wealth often grows slowly at first and then more rapidly as time passes. Those who understand this principle learn to appreciate patience as a powerful ally. Yet patience alone does not guarantee success. Even with the power of compounding, investors must avoid actions that quietly damage their progress. One of the most common mistakes is excessive activity in the market. And that brings us to the next rule of the Investor's Code. Rule 11. Avoid unnecessary trading. In the modern financial world, activity is often mistaken for intelligence. Investors are surrounded by constant information. Market updates appear every minute. Experts share predictions. New opportunities are discussed everywhere. This environment creates the feeling that investors must always be doing something: buy quickly, sell quickly, react to every change in the market. But experienced investors know that constant activity can quietly damage long-term results. Frequent trading often creates more problems than benefits. Every time an investor buys or sells, there are costs involved. Transaction fees may appear small, but repeated actions can slowly reduce returns. Taxes on short-term profits can also reduce overall gains. Beyond financial costs, frequent trading also creates emotional pressure. When investors constantly monitor prices, they become more sensitive to small market movements. Every rise creates excitement. Every decline creates anxiety. This emotional cycle often leads to impulsive decisions. Warren Buffett once explained this idea with his usual clarity. He said that the stock market is designed to transfer money from the active to the patient. These words challenge a common belief. Many people assume that successful investors must constantly trade to capture opportunities. In reality, some of the most successful investors make relatively few decisions each year. They focus on choosing good investments and then allowing time to work in their favor. Peter Lynch also shared a similar observation during his years managing the Fidelity Magellan Fund. He often noted that investors sometimes spend more time worrying about market timing than understanding the businesses they own. But timing the market consistently is extremely difficult. Even professional investors rarely succeed at predicting short-term movements with accuracy. Trying to buy at the exact bottom or sell at the exact top often leads to frustration and poor decisions. Instead of chasing perfect timing, disciplined investors concentrate on long-term ownership. They select strong businesses at reasonable prices and hold them while those businesses grow. This approach reduces unnecessary activity and allows compounding to continue uninterrupted. Charlie Munger once described investing success in a very simple way. He said that the big money is not in the buying or the selling. The big money is in the waiting. Waiting requires patience and confidence. It means trusting your research and resisting the urge to react to every piece of market news. Of course, this does not mean investors should never sell. Sometimes businesses change. New information appears, or better opportunities emerge. When these situations occur, thoughtful adjustments may be necessary. But these decisions should come from careful analysis, not emotional reaction. Unnecessary trading usually happens when investors confuse movement with progress. They feel that constant activity proves they are being productive. In reality, thoughtful inactivity can be one of the most powerful strategies in investing. By avoiding excessive trading, investors reduce costs, limit emotional mistakes, and allow their investments the time needed to grow. This calm and disciplined approach transforms investing from a stressful activity into a thoughtful, long-term process. Yet even the most patient investors will face moments when things do not go as planned. Markets will fall. Businesses will struggle. Some investments will disappoint. When these moments arrive, another important principle becomes essential. Because mistakes are not the end of the investing journey. They are part of the learning process, and that leads to the next rule of the Investor's Code. Rule 12. Learn from mistakes calmly. No investor succeeds without making mistakes. Markets are uncertain. Businesses change. Even careful research cannot guarantee perfect outcomes. Losses and wrong decisions are part of the investing journey. What separates successful investors from unsuccessful ones is not the absence of mistakes. It is how they respond to those mistakes. Some investors react with frustration and regret. They blame the market, blame circumstances, or blame others. In doing so, they miss the opportunity to learn. Wise investors take a different approach. They examine their mistakes calmly and honestly. Instead of asking who is responsible, they ask what can be learned. This mindset transforms every setback into a valuable lesson. Ray Dalio, the founder of Bridgewater Associates, often speaks about the importance of learning from errors. He once explained that pain plus reflection equals progress. Mistakes become useful only when they are carefully studied. For example, an investor may buy a company without fully understanding its business model. Later, the investment performs poorly because the company faces strong competition. Instead of ignoring the experience, the investor studies what went wrong. Did the research miss important information? Were warning signs ignored? Was the decision influenced by excitement or pressure from others? Answering these questions builds wisdom for future decisions. Many legendary investors openly admit that some of their greatest lessons came from failure. Warren Buffett has often spoken about investments he wishes he had handled differently. Instead of hiding those experiences, he shares them as reminders of the importance of discipline and careful thinking. This humility allows investors to grow stronger over time. Mistakes also teach an important psychological lesson. They remind investors that certainty does not exist in financial markets. No matter how much research is done, unexpected outcomes are always possible. Accepting this uncertainty encourages careful decision-making and realistic expectations. Another important benefit of learning from mistakes is the development of emotional resilience. Losses can feel uncomfortable, but when investors approach them with curiosity instead of fear, those experiences become valuable teachers. Each mistake adds to the investor's understanding of markets, businesses, and human behavior. Over time, this knowledge becomes a powerful advantage. It allows investors to recognize patterns more quickly. It helps them avoid repeating the same errors. And it strengthens their ability to make better decisions in the future. Charlie Munger once explained that a wise person learns not only from their own mistakes, but also from the mistakes of others. This idea encourages continuous learning. By studying financial history and observing how other investors succeeded or failed, we gain insights without paying the full cost of those lessons ourselves. In this way, the investing journey becomes an ongoing education. Every decision provides feedback. Every experience adds understanding. The key is to remain calm, honest, and curious. Instead of fearing mistakes, disciplined investors treat them as stepping stones toward greater wisdom. This attitude transforms setbacks into opportunities for improvement. But learning from mistakes requires something else as well. It requires a willingness to keep learning continuously. Because markets evolve, industries change, and new opportunities appear over time. An investor who stops learning quickly falls behind. And that brings us to the next rule of the investor's code. Rule 13. Keep learning every day. Investing is not a skill that is mastered once and then forgotten. It is a lifelong process of learning, observing, and improving. Markets change. Industries evolve. New technologies reshape the world. Businesses rise, transform, and sometimes disappear. Because of this constant change, investors who stop learning eventually fall behind. Knowledge is one of the most valuable assets an investor can possess. The more you understand about businesses, economics, psychology, and history, the better your decisions become. Warren Buffett once shared a simple habit that shaped his entire career. He spends a large part of his day reading annual reports, books, financial statements, articles about industries and companies. When asked about the secret of his success, Buffett once raised a stack of papers and said, "Read 500 pages like this every day. That is how knowledge works. It builds up like compound interest." This statement reveals an important idea. Just as money compounds over time, knowledge also compounds. Every new insight builds upon previous understanding. Over the years, this accumulation of knowledge creates powerful clarity. Charlie Munger often speaks about the importance of building what he calls a latticework of mental models. A mental model is a framework for understanding how the world works. These models come from many fields of knowledge. Economics helps explain incentives and markets. Psychology helps explain human behavior and decision-making. Business knowledge reveals how companies create value. History shows patterns that repeat across generations. When investors combine ideas from many disciplines, they gain a deeper perspective. Instead of viewing investments from a single angle, they see the bigger picture. This broad understanding helps investors recognize both opportunities and risks more clearly. Learning also protects investors from overconfidence. When people believe they already know everything, they stop asking questions, they stop exploring new ideas, and their thinking becomes rigid. But curious investors remain open-minded. They continue studying even after achieving success. They seek new information and challenge their own assumptions. Peter Lynch once encouraged investors to stay curious about the world around them. He believed that many investment ideas come from simple observation. New products appear in stores. Innovative services attract loyal customers. Industries change in response to new technologies. Observing these developments helps investors understand how the economy evolves. Learning also builds patience and confidence. When investors deeply understand businesses and markets, they are less likely to panic during temporary uncertainty. They recognize that short-term volatility is part of the long-term journey. The habit of continuous learning transforms investing into an intellectual adventure. Each book, article, and conversation adds another piece to the puzzle of understanding markets. Over time, this growing knowledge base helps investors make wiser decisions and avoid costly mistakes. But learning alone is not enough. Knowledge must be combined with discipline and careful protection of capital. Because even the most knowledgeable investors can face difficult situations in unpredictable markets. That is why the next rule of the Investor's Code focuses on one of the most important priorities in investing. Rule 14: Protect first, grow second. Many people enter the world of investing with a single goal in mind. They want their money to grow as quickly as possible. They search for opportunities that promise large returns and exciting possibilities. Growth is important, but wise investors understand that protection must always come first. Before thinking about how much money can be gained, a disciplined investor first asks how much money could be lost. This mindset creates stability and long-term success. Benjamin Graham, the father of value investing, often emphasized the importance of protecting capital. He believed that the primary objective of an intelligent investor is not maximum profit but reasonable profit with minimum risk. In other words, preserving wealth is just as important as building it. Consider a simple example. If an investor loses half of their capital, recovering from that loss becomes extremely difficult. A loss of half requires the remaining capital to double just to return to the original level. This shows how damaging large losses can be. Warren Buffett often speaks about protecting capital with great seriousness. He once explained that the first rule of investing is never lose money. The second rule is never forget the first rule. Of course, no investor can avoid every loss. Markets fluctuate and unexpected events sometimes occur. But Buffett's statement highlights an important philosophy. Avoiding major losses is more important than chasing extraordinary gains. When investors focus only on growth, they sometimes take excessive risks. They invest in companies they do not understand. They chase popular trends. They borrow money to increase their exposure to the market. These actions can create short-term excitement, but they also increase the danger of serious losses. Disciplined investors take a different approach. They think like careful guardians of their capital. They analyze risks before committing their money. They prefer steady progress over dramatic speculation. This mindset leads to stronger long-term outcomes. Howard Marks once explained that successful investing is not about avoiding risk completely. It is about managing risk intelligently. Investors must accept that uncertainty will always exist, but they can reduce danger through thoughtful decisions. One important way to protect capital is by maintaining a margin of safety. When investors buy assets at reasonable or discounted prices, they create a buffer against mistakes or unexpected events. If the future does not unfold exactly as expected, this margin of safety can reduce the damage. Another method of protection is diversification. By spreading investments across different companies and industries, investors reduce the impact of a single failure. Strong investors also remain cautious during periods of market excitement. When prices rise rapidly and optimism fills the market, many people forget about risk. They believe that success will continue indefinitely. But history shows that markets move in cycles. Periods of optimism are often followed by periods of correction or decline. Investors who remember this reality are less likely to take reckless risks during moments of excitement. Protection also involves emotional discipline. Fear and greed can push investors toward poor decisions. Protecting capital requires calm thinking, even when markets become unpredictable. Over long periods of time, this careful mindset builds resilience. Investors who avoid catastrophic losses remain in the game. They maintain the ability to take advantage of future opportunities. In contrast, those who suffer large losses may struggle to recover and may even abandon investing altogether. This is why protecting capital must always come before pursuing growth. Growth without protection can be fragile, but protection combined with steady growth creates lasting wealth. Wise investors understand that the journey toward financial success is not a race. It is a long and thoughtful process that rewards patience, discipline, and caution. Once an investor learns to protect capital carefully, another important challenge appears. Markets will sometimes become chaotic. Prices may fall rapidly. Fear may spread across the financial world. In those difficult moments, the investor must rely on something stronger than predictions. They must rely on clear thinking and emotional stability. And that leads to the next rule of the investor's code. Rule 15. Think clearly when others panic. Financial markets are driven not only by numbers and analysis, but also by human emotions. Fear and panic can spread quickly when uncertainty appears. When markets fall sharply, many investors feel a powerful urge to react immediately. News headlines become alarming. Predictions of disaster appear everywhere, and the crowd begins rushing to sell. In these moments, clear thinking becomes extremely difficult. Yet these moments often separate disciplined investors from emotional ones. Howard Marks once explained that successful investing often requires acting differently from the crowd. When others become fearful, the disciplined investor must remain thoughtful and calm. This is not easy. Human psychology pushes people towards safety in numbers. When many investors panic, the instinct is to follow them. But history shows that panic selling often leads to poor results. Markets move in cycles. Periods of growth are often followed by periods of decline. But declines do not always signal permanent failure. Sometimes they represent temporary uncertainty or emotional overreaction. Warren Buffett captured this idea in a famous statement. Be fearful when others are greedy, and be greedy when others are fearful. This does not mean blindly buying every falling investment. Instead, it means maintaining rational thinking when emotions dominate the market. During moments of panic, investors should return to the fundamentals. Is the business still strong? Does the company still serve its customers effectively? Has the long-term outlook truly changed? If the underlying business remains healthy, a falling price may represent opportunity rather than danger. Benjamin Graham's concept of Mr. Market becomes especially helpful during these times. Mr. Market is sometimes optimistic and sometimes depressed. During panic, he becomes extremely pessimistic and offers very low prices. The disciplined investor does not need to share his emotions. Instead, the investor can calmly evaluate whether the offered price represents value. Thinking clearly during panic requires preparation. Investors who understand their investments deeply are less likely to react impulsively. They have confidence in their research and long-term expectations. Preparation also includes maintaining financial flexibility. Investors who keep some capital available during uncertain times may find opportunities when others are forced to sell. Many legendary investors built significant wealth during periods of crisis. When markets collapsed and fear dominated the financial world, they remained patient and rational. They recognized that panic often pushes prices far below reasonable value. However, clear thinking does not mean ignoring risk. Some businesses do face permanent decline during economic turmoil. Careful analysis is still required before making decisions. The goal is not blind optimism, but balanced reasoning. Calm investors examine facts rather than reacting to emotions. They understand that markets often exaggerate both good news and bad news. This perspective allows them to act thoughtfully when others feel overwhelmed. Over time, the ability to remain calm during panic becomes a powerful advantage. While many investors make emotional decisions during crises, disciplined investors maintain clarity and patience. This emotional strength helps them navigate uncertainty and recognize opportunities hidden within chaos. But maintaining calm during panic requires something deeper than courage. It requires a mindset that values patience and simplicity over constant activity. Because successful investing is often less about doing more and more, about doing less with greater discipline. And that leads to the next rule of the investor's code. Rule 16. The art of doing less but achieving more. In many areas of life, people believe that success requires constant action. Working harder, moving faster, and doing more often appears to be the path to achievement. But investing follows a different rhythm. In the financial markets, doing less can often produce better results than doing more. This idea may sound unusual at first. After all, investors are surrounded by activity. News flows every hour, prices change every second. Experts share predictions and strategies every day. This constant movement creates the impression that successful investors must always react quickly. Yet history reveals a surprising truth. Some of the most successful investors achieve their results not through constant activity but through patience and selectivity. Warren Buffett once described his investing approach in a very simple way. He said that investing is like baseball, except there are no called strikes. In baseball, a player must swing the bat before 3 strikes are called. But in investing, there is no such pressure. An investor can watch opportunity after opportunity pass by without taking action. And when the right opportunity finally appears, the investor can act with confidence. This philosophy encourages patience and careful judgment. Instead of reacting to every market movement, disciplined investors wait for situations where the odds clearly favor them. This approach reduces unnecessary decisions and helps investors avoid costly mistakes. Charlie Munger once explained that many investors fail because they feel the need to constantly prove they are active and intelligent. But intelligent investing often requires the opposite attitude. It requires the humility to wait and the discipline to act only when the opportunity is truly attractive. The art of doing less also protects investors from emotional reactions. When people monitor the market constantly, they become more sensitive to short-term fluctuations. Small price movements begin to feel important even when they are not. This emotional pressure often leads to unnecessary buying and selling. By stepping back and focusing on long-term value, investors reduce this noise. They allow their investments to develop naturally over time. This patience also strengthens the power of compounding. When investments are held for long periods, the returns can accumulate steadily. Interrupting this process too often can weaken the compounding effect. John Bogle, the founder of Vanguard, often encouraged investors to focus on simplicity. He believed that successful investing does not require constant complexity. Instead, it requires discipline, patience, and a long-term perspective. Doing less does not mean ignoring your investments completely. It means focusing on the decisions that truly matter. Choosing strong businesses, paying reasonable prices, allowing time for growth. These decisions create a solid foundation for long-term success. Once this foundation is established, the investor's role becomes one of observation rather than constant intervention. Markets will continue to move. Prices will fluctuate. But thoughtful investors remain patient. They trust their process and avoid the temptation to act unnecessarily. This calm approach allows them to achieve more with fewer decisions. Over time, this philosophy transforms investing into a disciplined and thoughtful journey rather than a constant struggle for action. But patience and simplicity must be supported by another important principle. Because even the most patient investor must ensure that their investments remain balanced and resilient. And that leads to the next rule of the investor's code. Rule 17. Build a balanced and resilient portfolio. Investing is not only about selecting a single great company, it is about building a collection of investments that can survive different economic conditions. A balanced portfolio helps investors remain stable during uncertain times. Markets do not move in one direction forever. Some industries grow rapidly during certain periods. Others may struggle during those same years. Economic conditions change. Interest rates rise and fall. Technological innovation transforms industries. Because of these changes, investors must build portfolios that can adapt and endure. A resilient portfolio does not depend on a single outcome. Instead, it contains a thoughtful mix of investments that complement each other. For example, some companies may provide steady and predictable earnings. Others may offer stronger growth potential. Some industries may perform well during economic expansion. Others may remain stable during economic slowdowns. When these different elements are combined carefully, the portfolio becomes stronger and more balanced. Ray Dalio, one of the most respected investors in modern finance, often speaks about the importance of balance. He explains that the future is always uncertain, and no investor can predict every possible scenario. A well-balanced portfolio prepares for multiple possibilities instead of relying on a single prediction. This approach reduces the impact of unexpected events. If one investment performs poorly, others may provide stability or growth. The portfolio continues moving forward even when certain parts face difficulties. Balance also protects investors from emotional stress. When too much money is placed in one investment, every price movement feels dramatic. A sudden decline can create anxiety and panic, but when investments are spread thoughtfully across different opportunities, no single outcome dominates the entire portfolio. This stability allows investors to think more clearly and remain patient during market fluctuations. Another important aspect of resilience is financial strength. Companies with strong balance sheets, responsible leadership, and sustainable business models often survive difficult economic conditions better than weaker competitors. Including such businesses in a portfolio increases its ability to withstand uncertainty. Peter Lynch once encouraged investors to understand the companies they own and observe how they perform over time. By studying businesses carefully, investors can identify companies with durable advantages and loyal customers. These businesses often contribute to the long-term strength of a portfolio. Resilience also requires regular reflection. Investors should occasionally review their portfolios to ensure that their investments still match their long-term goals and expectations. However, this review should not lead to constant changes. The purpose is thoughtful observation, not unnecessary action. A balanced portfolio evolves gradually as new opportunities appear and circumstances change. This thoughtful evolution helps investors maintain stability while still adapting to the changing world. In the end, a resilient portfolio reflects wisdom and preparation. It acknowledges that uncertainty is part of investing. Instead of fearing that uncertainty, it prepares for it through careful balance and diversification. This preparation allows investors to remain calm even when markets become unpredictable. But building a resilient portfolio also requires something deeper than strategy. It requires humility and the willingness to accept that the future will always contain surprises. Because no investor, no matter how experienced, can ever know everything with certainty. And that realization leads naturally to the next rule of the investor's code. Rule 18. Stay humble in the face of markets. Success in investing can be both rewarding and dangerous. When investors experience a series of profitable decisions, confidence naturally grows. They begin to believe their judgment is always correct. They feel certain about their predictions and comfortable with taking larger risks. Confidence is important, but overconfidence can quietly destroy discipline. Financial markets are complex systems influenced by millions of participants, economic forces, technological changes, and human emotions. No individual can fully control or predict these forces. This is why humility is one of the most valuable qualities an investor can develop. Humility reminds investors that uncertainty always exists. Even the most experienced professionals make mistakes. Warren Buffett, despite decades of extraordinary success, often speaks openly about decisions he wishes he had made differently. Instead of pretending to be perfect, he acknowledges that investing requires continuous learning and adaptation. This attitude keeps the mind flexible and open to new information. Overconfidence, on the other hand, often leads to reckless behavior. An investor who believes they cannot be wrong may ignore important warning signs. They may concentrate too much capital in a single idea. They may take unnecessary risks because past success has created the illusion of certainty. History provides many examples of talented investors who lost enormous wealth after becoming overconfident. Humility protects investors from these dangers. A humble investor understands that markets can behave in unexpected ways. They remain cautious even when their recent investments have performed well. Instead of assuming that success will continue indefinitely, they continue studying, analyzing, and questioning their assumptions. Charlie Munger often emphasizes the importance of recognizing the limits of human knowledge. He encourages investors to admit when they do not fully understand a situation. This honesty prevents costly mistakes. When investors acknowledge uncertainty, they become more careful in their decisions. They seek a margin of safety. They diversify their portfolios. They avoid unnecessary risks. Humility also encourages patience. Investors who feel the need to constantly prove their intelligence often trade too frequently. They want to demonstrate their ability to predict markets. But humble investors are comfortable waiting for opportunities that truly make sense. They understand that good decisions matter more than frequent decisions. Another important benefit of humility is the ability to listen and learn from others. Financial wisdom has been built over generations. Great investors study the experiences of those who came before them. They read books, examine historical market events, and listen to thoughtful perspectives from other investors. This continuous learning strengthens their understanding of markets and human behavior. Humility also helps investors remain calm during both success and failure. During profitable periods, they avoid excessive pride. During difficult periods, they avoid despair. Instead, they maintain balance and perspective. This emotional stability allows them to stay focused on long-term goals rather than short-term fluctuations. In the end, humility reminds investors of an important truth. The market is larger and more complex than any individual participant. Respecting this reality encourages careful thinking, disciplined behavior, and thoughtful decision-making. But humility alone does not complete the investor's mindset. An investor must also understand that markets constantly evolve. New technologies appear, industries transform, economic conditions shift over time. Those who fail to adapt may struggle in a changing world. And that leads to the next rule of the investor's code. Rule 19. Adapt to change without losing discipline. The world of investing is constantly evolving. New technologies appear. Industries transform. Consumer behavior shifts. Economic conditions change over time. Companies that once dominated their industries sometimes fade away, while new businesses rise to take their place. Because of these changes, investors must remain flexible and open to new ideas. However, adapting to change does not mean abandoning discipline. Wise investors balance two important qualities. They remain open to new information, but they also stay grounded in timeless principles. History offers many examples of businesses that failed to adapt to changing conditions. Companies that once led entire industries sometimes ignored innovation or underestimated new competitors. As technology advanced and consumer preferences evolved, those companies lost their advantage. Investors who recognize these shifts early can protect themselves from declining industries and discover emerging opportunities. But adaptation must be thoughtful rather than impulsive. Financial markets often react strongly to new trends. Exciting innovations can create waves of speculation and unrealistic expectations. During these moments, investors must remain careful. Not every new idea becomes a lasting success. Some innovations transform the world, while others fade after initial excitement. Disciplined investors analyze new developments carefully. They study how a new technology works. They observe whether customers truly value the product or service. They evaluate whether the business model can remain profitable in the long run. This thoughtful approach helps investors separate genuine progress from temporary hype. Jeff Bezos once explained that while technology changes rapidly, certain human needs remain constant. People will always value convenience, efficiency, and reliability. Investors who understand these enduring needs can better evaluate whether a new business has long-term potential. Adaptation also means recognizing when a previous assumption is no longer valid. Sometimes an investor discovers that a company they once admired is losing its competitive advantage. New competitors may offer better products. Consumer demand may shift in unexpected ways. When evidence shows that the long-term outlook has changed, disciplined investors are willing to reconsider their decisions. This flexibility prevents loyalty to outdated ideas. However, adaptation must never replace careful thinking. Some investors chase every new trend they encounter. They constantly move from one opportunity to another, hoping to capture rapid profits. This behavior often leads to confusion and poor results. Wise investors adapt gradually and thoughtfully. They maintain a consistent philosophy while adjusting their strategies to reflect new realities. This balance between stability and flexibility creates resilience. The investor remains prepared for a changing world without losing the discipline that protects long-term success. Over time, this mindset allows investors to navigate different economic cycles and technological transformations. They remain curious about the future while respecting the lessons of the past. But even the most adaptable investors must remember another important truth. No strategy can eliminate uncertainty completely. Unexpected events will always occur. Markets will sometimes behave unpredictably. In those moments, one quality becomes more valuable than any prediction or model. That quality is patience. And that leads to the next rule of the investor's code. Rule 20. Patience is the investor's greatest advantage. In the fast-moving world of finance, patience often feels like a forgotten virtue. Everywhere investors are encouraged to act quickly. News channels discuss market movements every hour. Experts share predictions about what might happen tomorrow. Opportunities appear and disappear with great speed. This environment creates the impression that successful investing requires constant activity and rapid decisions. But the reality is very different. Many of the greatest investing achievements in history were built through patience rather than speed. Warren Buffett often reminds investors that wealth is rarely created overnight. Instead, it grows gradually through disciplined decisions and long periods of waiting. Patience allows time to do its work. When a strong business grows steadily year after year, its value increases gradually. Earnings expand. Customers remain loyal. New opportunities appear within the business. Investors who remain patient during this process allow their investments to mature. Those who demand quick results often interrupt this natural growth. They sell too early. They chase new opportunities. They become distracted by short-term fluctuations in price. Each of these actions weakens the long-term potential of compounding. Charlie Munger once explained that the big money is not in the buying or the selling. The big money is in the waiting. This simple statement captures the essence of patient investing. Waiting is difficult because markets constantly test the investor's confidence. Prices rise and fall. Economic conditions change. Unexpected events create temporary uncertainty. During these periods, impatience can become a powerful temptation. Investors may feel that they must take action to protect themselves or capture a new opportunity. But disciplined investors understand that not every moment requires a decision. Sometimes the wisest action is simply to remain calm and allow time to pass. Patience also helps investors avoid emotional mistakes. Fear often pushes people to sell during market declines. Greed encourages them to buy during periods of extreme optimism. Both reactions are driven by short-term emotion rather than long-term reasoning. Patient investors step back from these emotional waves. They remember that markets move in cycles. Periods of growth are often followed by periods of correction. But over long periods, strong businesses continue creating value. John Bogle, the founder of Vanguard, often encouraged investors to stay the course. His philosophy emphasized the importance of discipline and long-term commitment. By remaining patient and avoiding unnecessary reactions to market noise, investors increase their chances of success. Patience also creates opportunities. During times of market panic, many investors rush to sell their holdings. Prices may fall far below reasonable value. Patient investors who have prepared carefully can recognize these moments. They remain calm while others panic. They evaluate opportunities thoughtfully instead of reacting emotionally. Over time, these decisions can produce extraordinary results. However, patience should never be confused with passivity. Patient investors still study businesses carefully. They continue learning about markets and industries. They observe how their investments develop over time, but they avoid the temptation to act simply for the sake of activity. Their patience is guided by knowledge and discipline. This mindset transforms investing into a long journey rather than a series of short races. Progress may appear slow at times, but the steady accumulation of knowledge, experience, and compounding returns gradually creates powerful results. The investors who achieve lasting success are often those who remain calm and patient while others rush from one opportunity to another. They understand that time is not an obstacle in investing. Time is the greatest ally of those who are willing to wait. Yet patience must be supported by another important principle. An investor must remain careful about the use of borrowed money and financial obligations. Because while patience creates stability, excessive debt can quickly destroy it. And that leads to the next rule of the investor's code. Rule 21. Avoid debt whenever possible. In the world of investing, the promise of faster growth can sometimes tempt investors toward dangerous shortcuts. One of the most common shortcuts is the use of debt. Debt allows investors to control larger investments than their own capital would normally allow. At first glance, this may seem like an attractive strategy. If the investment succeeds, the profits can appear larger. However, debt also magnifies risk. While gains may increase, losses can grow even faster. This is why many experienced investors treat debt with great caution. Borrowed money creates obligations. Interest must be paid. Repayments must be made on schedule. These obligations remain regardless of how the market behaves. If investments decline in value while debt remains, financial pressure can increase quickly. History offers many examples of investors who suffered severe losses because of excessive borrowing. During periods of market optimism, some investors borrow heavily to increase their exposure to rising assets. As long as prices continue rising, this strategy may appear successful. But when markets suddenly decline, the situation can change dramatically. Losses grow rapidly. Lenders may demand repayment. Investors may be forced to sell assets at the worst possible moment. These forced decisions can turn temporary declines into permanent financial damage. Warren Buffett has often warned about the dangers of unnecessary leverage. He once explained that if you are smart, you do not need it, and if you are not smart, it can destroy you. This statement reflects Buffett's philosophy of steady and disciplined investing. He believes that wealth built slowly through patience and careful decisions is far more sustainable than wealth built through risky shortcuts. Avoiding debt also creates emotional stability. When investors rely only on their own capital, they have greater flexibility. They can remain patient during market fluctuations without worrying about immediate financial obligations. This freedom allows them to focus on long-term opportunities rather than short-term pressures. Debt, on the other hand, often creates stress and urgency. Investors who rely heavily on borrowed money may feel forced to make quick decisions. They may sell investments prematurely or chase risky opportunities in an attempt to meet their obligations. This pressure can weaken judgment and lead to costly mistakes. Benjamin Graham often emphasized the cycles of optimism and pessimism. Periods, cycles of optimism and pessimism. Periods of growth are sometimes followed by sudden declines. Investors who maintain strong financial positions can endure these cycles with confidence. Those burdened by heavy debt may struggle to survive even temporary downturns. This is why disciplined investors prefer building wealth gradually through savings and careful investment rather than relying on borrowed money. There may be situations in business where responsible borrowing supports growth and innovation. But for individual investors, excessive leverage often introduces unnecessary danger. Financial independence is strengthened when obligations are limited. Investors who avoid debt gain greater control over their decisions and their future. They remain free to wait patiently for opportunities and avoid the stress of urgent repayments. Over time, this cautious approach supports steady and sustainable wealth creation. By relying on discipline rather than leverage, investors build a foundation that can endure changing market conditions. But avoiding debt leads naturally to another important insight. When investors truly think like owners rather than gamblers, their decisions become more thoughtful and responsible, because every investment represents a share of a real business. And that leads to the next rule of the investor's code. Rule 22. Think like an owner, not a gambler. Many people approach the stock market with the mindset of a gambler. They watch prices rise and fall. They chase quick profits. They try to predict short-term movements as if the market were a casino. This mindset transforms investing into speculation. Instead of focusing on the real value of businesses, attention shifts toward rapid price changes and short-term excitement. But wise investors follow a completely different philosophy. They think like owners. When you buy shares of a company, you are not simply purchasing a number on a screen. You are becoming a partial owner of a real business. That business employs people. It creates products or services. It competes in an industry and generates profits through its operations. Viewing investments through this ownership perspective changes the entire approach to decision-making. Warren Buffett has always emphasized this idea. He often says that when he buys shares, he imagines buying the whole business. This mindset encourages deeper thinking. Instead of asking whether the price will rise tomorrow, the investor asks more meaningful questions. Is the business strong and well managed? Does it serve customers effectively? Does it have advantages that competitors cannot easily copy? Can it grow and remain profitable over many years? These questions focus attention on the fundamentals of the business, rather than the daily movements of the market. Thinking like an owner also encourages patience. When someone owns a successful restaurant, factory, or store, they do not expect immediate profits every single day. They understand that business performance can fluctuate from time to time. However, if the business is fundamentally strong, it will likely create value over the long run. Investors who adopt this perspective are less likely to panic during temporary market declines. They know that short-term price movements do not always reflect the true condition of the business. Benjamin Graham described the stock market as a place where emotional reactions often dominate in the short term. But over longer periods, the true value of businesses becomes clearer. Owners focus on long-term results. Gamblers focus on short-term movements. This distinction creates a powerful advantage for disciplined investors. Gamblers are constantly searching for the next exciting opportunity. They move rapidly from one trade to another. Owners remain thoughtful and selective. They carefully choose businesses with strong foundations and then allow those businesses to grow over time. Peter Lynch once encouraged investors to imagine holding their investments even if the stock market closed for several years. This thought experiment helps investors focus on the true strength of the business rather than daily price fluctuations. If a company would still be attractive even without constant price updates, it may represent a strong long-term investment. Thinking like an owner also encourages responsibility. Owners care about the quality of leadership, the integrity of management, and the long-term sustainability of the business. They understand that leadership decisions influence the future success of the company. This perspective leads investors to study annual reports, company strategies, and competitive advantages more carefully. Instead of chasing rumors or predictions, they base their decisions on thoughtful analysis. Over time, this ownership mindset transforms investing into a disciplined process of selecting and supporting strong businesses. It replaces speculation with thoughtful participation in the growth of real companies. The result is a calmer and more intelligent approach to building wealth. But even as investors adopt this ownership mindset, another important realization begins to emerge. Wealth itself is not the final destination. Money can create security and opportunity, but it also carries responsibility. Great investors throughout history have often reflected on the purpose of wealth and the role it can play in society. And that leads to the next rule of the investor's code. Rule 23. Remember that wealth has a purpose. As investors progress along the path of building financial success, an important question eventually appears. What is wealth truly for? Money can provide comfort, security, and freedom. It can create opportunities and remove many of life's daily pressures. But wealth by itself is not the final destination. If money becomes the only goal, the journey can feel empty even when financial success is achieved. Wise investors eventually realize that wealth has a deeper purpose. Money is a tool. It is a resource that can shape lives, support families, strengthen communities, and create opportunities for future generations. Throughout history, many of the world's most successful investors have reflected on this responsibility. Andrew Carnegie, one of the most famous industrialists of the 19th century, once wrote that the man who dies rich dies disgraced. His message was not a criticism of wealth itself. Instead, it was a reminder that wealth carries responsibility. Carnegie believed that those who achieve great financial success should also use their resources to improve society. Later in life, he dedicated much of his fortune to building libraries, universities, and educational institutions. His example illustrates how wealth can extend beyond personal gain. Warren Buffett has expressed a similar philosophy. Despite being one of the most successful investors in history, he has repeatedly emphasized that wealth should serve a broader purpose. Buffett has pledged the majority of his fortune to philanthropic causes, believing that capital can do tremendous good when directed towards solving important problems. These examples remind us that financial success can become a platform for positive impact. Wealth can support education. It can fund medical research. It can strengthen communities and help those facing hardship. Even on a smaller scale, responsible use of wealth can improve the lives of family members and future generations. Parents can invest in the education of their children. They can create financial stability that allows the next generation to pursue meaningful careers rather than being driven only by financial pressure. Investors who think about purpose often make wiser decisions throughout their journey. When money is viewed as a tool rather than a trophy, financial decisions become more thoughtful and balanced. Greed becomes less powerful. Short-term temptations lose their influence. Instead of chasing wealth for its own sake, investors focus on building something lasting and meaningful. Purpose also creates perspective during difficult times. Markets will rise and fall. Investment performance will vary from year to year. But when wealth is connected to a larger purpose, temporary financial fluctuations become less overwhelming. The investor remembers that money is only one part of a meaningful life. Purpose also encourages generosity and gratitude. Those who recognize the opportunities created by their financial success often feel a natural desire to share those opportunities with others. This generosity does not always require enormous fortunes. Even modest resources can make meaningful contributions when used thoughtfully. Helping a family member pursue education, supporting a community project, contributing to causes that improve the lives of others. These actions reflect the deeper value of wealth. Money becomes a force that extends beyond individual success. Charlie Munger often reminds investors that a meaningful life is built not only on financial achievements, but also on wisdom, character, and contribution. Wealth can support these values when it is guided by purpose. In the end, the journey of investing is not simply about accumulating assets. It is about creating stability, opportunity, and the freedom to pursue meaningful goals. When investors remember this purpose, their decisions become more balanced and thoughtful. They recognize that wealth is most powerful when it is connected to responsibility and generosity. But after reflecting on the purpose of wealth, the final lesson of the investor's code becomes clear. Because beyond strategies, numbers, and financial outcomes, investing ultimately shapes something even more important. It shapes the legacy we leave behind. And that brings us to the final rule of the investor's code. Rule 24. Build a legacy of wisdom and discipline. Every investor begins their journey with a personal goal. Some seek financial security. Others seek independence, opportunity, or the freedom to shape their own future. Over time, however, The journey of investing often becomes something larger than personal success. It becomes a story about legacy. A legacy is not only the wealth a person leaves behind, it is also the knowledge, values, and discipline that guide future generations. Money can disappear quickly if it is not supported by wisdom. But when financial knowledge and disciplined habits are passed forward, the benefits can last for generations. This is why the final rule of the Investor's Code focuses not only on wealth but also on understanding. Successful investors learn valuable lessons during their journey. They learn patience. They learn emotional control. They learn the importance of long-term thinking and careful decision-making. These lessons are often more valuable than the wealth itself. When shared with others, they create a lasting foundation for financial stability. Warren Buffett has often spoken about the importance of teaching younger generations how to think about money. He believes that understanding simple principles such as saving, investing, and patience can shape a lifetime of financial security. Without this understanding, even large fortunes can disappear within a few generations. History offers many examples of families who accumulated great wealth but failed to pass along the discipline required to preserve it. When financial knowledge disappears, wealth often follows. But when wisdom and discipline are shared openly, future generations gain the tools needed to build their own success. A legacy of wisdom encourages responsible decision-making. Children and future family members learn that wealth is not created through luck or speculation. They understand that it grows through patience, learning, and thoughtful choices. This knowledge empowers them to approach money with confidence and responsibility. Legacy also extends beyond family. Investors who share their experiences through writing, teaching, mentoring, or philanthropy can influence many lives. Books written by thoughtful investors continue to educate readers decades after they were first published. Lessons shared today may guide people who the investor will never personally meet. In this way, financial wisdom becomes a gift that continues giving long into the future. Charlie Munger once explained that the best thing a human being can do is help another human being know more. This idea reflects the deeper purpose of knowledge and experience. By sharing insights and lessons, investors help others avoid mistakes and build stronger financial foundations. Legacy also includes character. Integrity, honesty, patience, and discipline are qualities that influence every decision in investing and in life. When these values guide financial choices, wealth becomes a reflection of responsible behavior rather than reckless speculation. A disciplined investor builds more than a portfolio. They build a reputation for thoughtful judgment and reliable character. This reputation becomes part of their legacy as well. Over time, the lessons of investing reveal something profound. Wealth is not simply a number in an account. It is the result of habits repeated over many years. Saving consistently, investing thoughtfully, remaining patient through uncertainty, continuing to learn and improve. These habits shape both financial outcomes and personal character. When passed forward, they create a powerful influence that extends far beyond the individual investor. In the end, the Investor's Code is not only a guide for building wealth, it is a guide for building a thoughtful life, a life grounded in patience rather than haste, in discipline rather than impulse, in learning rather than certainty. The journey of investing teaches that time rewards those who remain calm, curious, and consistent. And those who follow these principles do more than accumulate wealth. They create a legacy of wisdom that can guide others for many years to come. This is the true meaning of the Investor's Code. Simple principles, timeless discipline, and a lasting legacy built through patience, knowledge, and thoughtful decisions.